It's one of my favorite times of the week. It is time to talk money. Brent, how are you doing today?
I'm doing great. Thank you for asking.
I'm so excited to talk to you because one of my favorite things, so he sends me notes in advance so I can compare, is you're so blunt with your topics. This is the note he sent me. Are consumers running out of money? So tell us, are they?
Yeah, and I hate sending those, but I look at stuff, and again, we're an investment advisory firm. We manage like $800 million in assets, so I got to watch this stuff, and I want to share with people that things are not looking that great because you got to be cautious when this happens. And consumers appear to be running out of money because of what's going on with the war in Iran, causing inflation, higher energy prices. And as an investor, this is important because if they don't have as much money before, they're not buying the product, so the companies maybe you own, therefore their sales are down, profits are down, stock goes down. So you got to watch this stuff, and we do watch it for people. And what came out last week was what they call PCE, which is personal consumption expenditures. That's an inflation indicator. And the Fed likes it better than the CPI. Well, it was 3.35% year over year. That is what it was expected, but it was the highest it's been since November 2023. So that is a problem that we have, is that inflation is rising, putting less money in people's pockets.
Let's talk about the personal savings, and I'll just be honest with people because I think a lot of people can relate to me on this. I just feel like I can't save. I mean, I really do feel like every penny that's coming in has to go right back out. So how does that stack up against what other people are doing?
Well, one thing it tells me is we need to do a segment on budgeting. That's one thing we got to do. But besides that, let's talk about what's going on. Personal savings rate.
Hey, I will say it. Sunless tanning is an essential.
Oh, yeah, we've got to talk off air, I think. But the personal savings rate, me save here, is now 2.6%, and that is low. I mean, last in May it was 3.2%. Last year, 5.8%. It's declining because people don't have as much money left over because they're doing their tanning salons and spending too much there. But in reality, what's happening? This is the worst it's been since the pandemic, and this is bad. And as I said, it's down year over year. 5.8% was what it was before. And you look at the savings rate back and before, like 2010 to 2020. Well, then it was like 5 to 7%. So we're way below where it should be. And this is a problem because people aren't saving, they're not investing. It's a problem because you're not going to have an emergency fund or a good future there.
Let's talk about the workers. So when it comes to types of saving, let's talk a little bit about the 401ks and other options that people are considering.
Yeah, 401ks, and I'm a big advocate of the old pension plans because you couldn't touch them. The company would do it for you, retired, you got your pension, you were fine. Well, they came up with this great idea years ago, and it was a good idea, that you can invest yourself for your retirement in a 401k. Great in the beginning. Well, over the years, I think to get more votes or whatever, Congress people started saying, oh, well, let's kind of loosen up the rules on that. Let's make it easier for people to do that. Let's allow them loans. Well, right now, about 19.2% of people have a loan on their 401k. Think about almost 1/5 of people. This is your retirement. I've talked about this before. This is your retirement. When you get to retirement, 15, 20 years from now, you may not have a good retirement. And you may have to say, well, gosh, I got to keep working, or I'm going to have a bad retirement. So it is so important not to use these advantages you get with a 401k. And people, again, 20% of people borrowing against their 401ks, that's terrible. It's up from 18.8% last year. So these are things I worry about.
And kind of in that same category, people facing a financial hardship, they can tap into that money early, right?
Yeah, I know some people aren't going to like when I say this, but there's actually no hardship that is really worthwhile that's going to hurt your retirement. And that's why the old pension plans, you can do that. But what's happening now, about, 6% now have taken hardship out of that. And that's where the money's not even borrowing it. You actually take it from there. And that's up from 4.8% last year. And it's for such things, which I think is a terrible idea for your first residence. I think it's a terrible idea. I know you want a home, but this is your retirement. Also, too, it's for things like tuition, terrible, funeral expenses. I mean, these are things you should not take from retirement because it won't be there when you need it. And it's become kind of like your 401k, it's become an emergency fund. No, it's for your retirement. Do not touch it no matter what, because you're going to have a terrible retirement.
Okay, wonderful, Brent. Thank you so much. And I think you all just got a sneak peek. I bet we're going to talk about budgeting next week. All right, we are out of time. I wish we could chat more. Don't go anywhere. We'll be right back.